market brief. This is the after-close wrap for May 1, 2026. Today's central question is, after intervention cools the macro panic, what risk does the market start looking at next? The headline numbers look calmer. The Nikkei 225 rose 0.38% to 59,513. Dollar yen fell 23% to around 156.6 after reports and estimates pointed to yen buying intervention. The S&P 500 also gained just over 1%, giving Japanese equities some global support. At first glance, that sounds like a relief rally. The yen had been under pressure near 160, authorities appeared to step in, and the market moved away from the most disorderly point. But the important part is that intervention does not make every risk disappear. It only changes the immediate problem. Before intervention, the market's question was whether yen weakness would become uncontrollable. After intervention, the question becomes more subtle. Can equities continue rising if the yen is no longer giving them the same automatic support? And once the macro panic fades, which company-specific risks become harder to ignore, that is why today's stock to watch is Sanrio, ticker 8136. After the market close, Sanrio announced that it would set up a special investigation committee over suspected improper compensation received by an executive. The company also postponed its planned May 13 earnings release. This is not just a small governance headline. Sanrio is a premium consumer IP growth story. Investors like it because the company owns characters, licensing power, overseas demand, and brand assets that can scale beyond Japan. That kind of stock often trades not just on current earnings, but on trust. Trust in the brand, trust in management, and trust in clean execution. The company has indicated that the financial impact is currently expected to be limited. If that remains true, the market may eventually treat the issue as contained. But the earnings delay is still important because it changes the near-term conversation. Instead of focusing only on brand momentum or international licensing growth, investors now have to ask whether the disclosure process and internal controls are strong enough to support a premium valuation. This also fits the broader market tone. On April 30, the market was dominated by policy risk, currency intervention, and the Makino milling machine takeover story. On May 1, intervention appeared to calm the currency side, but the market did not become simple. It shifted toward selectivity. Macro risk was reduced, and company-specific quality became more visible. There are three things to watch next. First, watch dollar yen during Golden Week. Liquidity can be thinner, and intervention risk can make positioning more unstable. If dollar yen holds near the mid-156 area, the market may treat intervention as an effective short-term floor. If it quickly retests the upper 150s, the pressure returns. Second, watch whether the Nikkei can rise without renewed yen weakness. A modest gain today is useful, but not decisive. A healthier market would need support from earnings, global risk appetite, and domestic flows, not just currency effects. Third, watch Sanrio's first trading reaction after the announcement. The key is whether investors treat the issue as an isolated governance problem, or whether they demand a wider discount for uncertainty around disclosure and internal controls. The day's lesson is straightforward. Policy action can calm the macro tape, but it does not remove the need for stock selection. Once the currency panic fades, the market starts asking a harder question. Which companies still deserve trust? That was Japan Market Brief.